Hello, everyone. So it's 9 a.m. straight, and we'll just start. Welcome to the Summer Investment Summit for high school students. We are going to have 8 fantastic guest speakers today, covering 14 topics across these next 2 days, 2 half days actually. All speakers will speak first, and we'll follow with a short Q&A. And we'll have a 10-minute break before the next speaker joins us. Please stay online and enjoy some free time. You can find more information on our website at summerinvestmentsummit.org.
We want this to be as interactive as possible, so please be sure to ask questions in the chat or during the Q&A session. We will introduce each speaker, and then they will get into what they're talking about. And without further ado, this is our first speaker, Mr. Sanford Leeds, and he is a professor at UT and has worked as a prosecutor and money manager. He has been a member of the faculty at UT for 21 years and puts out a free weekly newsletter that you can find at sandyleeds.com. We'll post that in the chat. And thank you so much, Mr. Leeds, for being here.
Great. Well, thank you so much. Thank you for inviting me to be here. Let me put up my slide deck so we've got it up here. So welcome to everyone who's here. Again, I appreciate being invited to speak to you. I think it's an awesome idea to get people thinking about the markets and investing and finance at a relatively early age. Some of you have probably already been thinking about it for quite some time, and others might be just dipping their toe in and trying to think about if this is something that's interesting to you and that you want to study in college. And I hope it is. I'm going to start with just one simple poll, and we'll just to sort of get people thinking. Don't feel funny about getting things wrong. We're not looking at who's answering and what your answer is, but we'll just look and see what you think. So over the next 20 years, what do you think the S&P 500 will average as far as returns? And then there's a second question that asks if the Fed thinks that inflation is going to be a persistent problem, what are they going to do? Do they raise rates or lower rates? Give you just about 30 seconds to do that, and then we'll close it out. All right, last call in case you want to answer it. And close it out here. Looks like some more answers coming in. All right, so let's take a look at the results. It looks like the majority of you said 4 to 9%. That's actually fascinating to me that you said that. I would agree with that answer, and I think if you asked the general public that question, and people who have been following the stock market for longer than you have, most likely on average, they would have a higher number than that. And I would say, excuse me, I think that 4 to 9% is probably right. And then you also got the other question, right, about the Fed thinks that, and not to say the first one you got right, we don't know who's right or who's wrong, but it shares my opinion. And the second one is, if the Fed thinks that inflation will be a persistent problem, what they do is they raise the Fed funds rate, as 80% of you said, in order to slow the economy. So I asked you about the returns because that's a super important idea, to have reasonable expectations. What I'm going to do today is I'm going to take you through my presentation is sort of divided into two parts. One is background knowledge that you should have, and then the other part is some key events that are that we're thinking about in the markets right now. And so I'm gonna Tiana, if you don't mind, there's an outline. If you could post the outline for everyone. It's just a one-page outline that will help you to follow along, and it will just it just always makes it easier if you sort of know where we're going. And so what you can see if you're looking at the outline is that we have two sections, sort of key knowledge, where we're going to talk about stock returns and understanding interest rates. And then we're going to talk about some key current events. So I don't know that we'll get through all of it, but I'll try to leave a few minutes to ask questions. So this is going to be probably the single most academic slide I'll show you. And I should tell you, as was mentioned, I'm I was a money manager. I ran the MBA investment fund for about 13 years, where we train students, MBA students, to become money managers. Now, what I mostly do at UT is I teach all about the markets and the economy, so that students who are going out and into these fields understand what's going on. The way I always describe the purpose of my class is for students to not feel like a fraud when they graduate. With academic knowledge, super important, but also understanding the real world. But here's how to think about what kind of returns you're going to earn over time. And that is, you have earnings growth, you have the change in the multiple, and the dividend yield. And we'll talk about what that means. So let's imagine you have a company that is selling. Let's just say they have earnings of $2 per share, and then they're selling for $10. I'm sorry, they're selling for 10 times earnings, or $20. So that 10 times earnings is called the PE multiple, the price earnings multiple. And so if you're selling at 10 times earnings and earnings are $2, that's a $20 stock. Well, let's imagine that it continues to sell at 10 times earnings, but the earnings grow 6% per year. Well, then your return is going to be 6% per year, plus any dividend you get. On the other hand, if the earnings grow plus the multiple expands, so instead of paying 10 times earnings, people are willing to pay 15 times earnings, then you're going to make even more. Of course, earnings can shrink, and multiples can contract, can become smaller. So let me just show you a quick sort of example of this. And I say stocks are currently trading at 14 times earnings. So that's the multiple. Over the next 5 years, you expect earnings to grow 6.5% per year, the multiple to expand to 16, and an annual dividend yield of 2.5%. What will your compound annual growth rate be? Your CAGR, your compound annual growth rate. How much are you going to earn per year? So I show you two different ways of solving this. So the easiest way to do it is, I didn't tell you what the earnings were. It doesn't matter what you start with. The answer will come out the same. So if you want to start for some reason with $3.46 of earnings, that's fine. It's just a little bit harder math. I start with $1. So if the multiple is 14 right now, and that's what we said, that stock's currently trading at 14 times earnings. Well, with $1 of earnings, that means the stock is worth $14. And if earnings are going to grow 6.5% per year, that dollar is going to grow to $1.37. And then I said at the end of 5 years, my expectation is that the multiple will be 16. And so you're going to have a $21.92 stock. So if a stock goes from $14 to $21.92 over 5 years, that's a 9.38% return. So you have your ending value divided by your beginning value raised to the one end, meaning how long it took. And you get the rate of return. If you skip to the bottom, then you have to add the dividend yield, and your total return is 11.88%. That first part where I got that 9.38, we could have done it in another way. We could have said, look, the multiple is going to expand from 14 to 16 over 5 years. So that's going to give us a 2.7% return. 1 plus that rate of return plus the 1 multiplied by 1 plus the earnings growth is going to come out to 9.38. So you're getting multiple expansion and earnings growth, and it's going to combine to a 9.38% return plus the dividend yield. So the point of this is not to really do the math, but really just to say to you that as an investor, when I'm thinking about a stock, what I'm thinking about is, are the earnings going to grow? And will the market find those earnings more or less valuable? In other words, will the multiple increase or decrease? And what I tell you is, as you start to invest or as you follow the market, the more you think like that, it'll give you a simple framework, right? So when you'll start to get used to the idea of how realistic is the growth that people are expecting, and am I really going to make money if I pay a really high multiple for a stock? In other words, if something's trading at 100 times earnings, that's unlikely to stay that way. Now, it's possible that the earnings are going to grow at a really fast rate right now, and they'll grow into that expensive price, but you start to get an idea of what's reasonable, what's not, when am I overpaying, when am I going to lose money? And so that's not something people get in a day or a week. It's something you get by watching the market over time. And I think, if you start now, boy, you're going to be so much better off. I have 3 kids, and they're two of them are older in college, and one of them is about to be a senior in high school, and one of them is really into this stuff, and they're doing well because of it. So if you're following along on the outline as we talk about stock returns, now I've told you we're not going to talk about dividends. Dividends with the S&P 500 tend to be 1.5% to 2% on average most of the time, but 1.5% to 2% return. But let's talk about the other 2 factors that are going to drive your returns. You've got earnings growth and you've got multiples. And the biggest thing to realize is this, that as the economy grows, earnings grow. All right, so what I have on this chart on the left is GDP, gross domestic product. That's the value of all the goods and services we produce in this country. And as we produce more in this country, you see corporate profits increase. And on the right, as corporate profits increase, as earnings increase, stock prices increase. And so that's one reason why we follow the economy, is that as the economy grows, companies are more profitable. As companies are more profitable, they're worth more. Now, this isn't a perfect slide, because if you think about like the S&P 500, those companies, somewhere between 35 and 55% of their revenue comes from overseas. So it's not just dependent on our economy, it's also dependent on other economies. But big picture, this is really good intuition to have. As the economy grows, profits grow. As profits grow, stock prices grow. That's as a stock investor, that's why I'm following the economy, or that's one reason. And then when we talk about multiples, one of the things to realize, and we'll see some other slides in this a little bit later, is that what happens is as interest rates are lower, multiples are higher. Meaning as interest rates go from, let's imagine interest rates go from 5% to 2%. What I would expect is multiples to increase. So in other words, instead of paying 12 times earnings, maybe I'm willing to pay 17 times earnings. And you might see that, you think of that's an inverse relationship. Interest rates go lower, multiples go higher. Here, what they've done is they've inverted the S&P 500. So that's why it shows the correlation, but it's really an inverse correlation. But what I want you to think about is just simply lower interest rates mean higher multiples. Higher interest rates mean lower multiples. So we're going to talk about that more later. When one of the other things that will impact multiples is sentiment. And there are times when investors are really scared. And when they're really scared, what they do is they sell everything. And there are other times when they're really optimistic and they're just buying. And we have an indicator that's called the VIX, the volatility index, but people just refer to it as the VIX. And the VIX, you'll learn about this if you study business when you go to college, but the VIX basically measures the volatility that's priced into options. But what you need to think about right now is just simply the idea that when people are scared, the VIX increases. And what I would just point out to you is, like, let's just look in June when the VIX was going up. People are scared. The market, this is the S&P 500 at the bottom, the market's going down. And then as people are becoming less scared, the market is going up. And that's what we're seeing right now. And so when people are less scared, they're willing to pay more for a dollar of earnings. That's a higher multiple. When people are more scared, they're less willing. And that's an important thing to understand, is that one of the ways you make money in the market, or one of the really important things to realize, is that you make money a lot of the time by having a different opinion than others and being right. Just being a contrarian, that just makes you annoying. But being a contrarian, being right, that's what makes you wealthy. And so, the idea is, you want to be fearful when everyone else is greedy, and you want to be greedy when everyone else is fearful. That's I think Warren Buffett, famous investor, or maybe the world's most famous investor, always says that. And so that's what you see here. One of the problems when you look at something like this, like the VIX, is I can't tell you in real time how high it's going to go. There are times it's gone up to 50, 60, 70 down during all that. So you can't just say, oh, anytime it goes above 30. I was speaking to a group earlier this week, and someone said, I heard a rule that if you sell every time the VIX goes above 30, and you buy every time, you buy every time it goes above 30, or you sell every time it goes below 20, will that work? And rules like that are sort of tough to implement. So anyway, that's the knowledge part of stock returns. Let's talk about interest rates real quick. And so interest rates, what I'm showing you here is what's called the yield curve. And some of you are familiar with this, some of you aren't. And you see this this is just a chart that's put out by one of the regional Federal Reserve banks, the Richmond Fed. And the blue line is the most recent. It's from just this past week. And the red line is from a month earlier. And they're trying to show us how yields have changed. But what this is showing you is interest rates, also called yields. And it's showing you interest rates for different time periods. And what we're talking about are on Treasury securities. Treasury securities, whether they're called Treasury bills, Treasury notes, Treasury bonds, all you need to worry about, or all practitioners worry about in the real world, is Treasury securities are securities issued by the US government. And the reason that the US government borrows money is that the US government takes in money in the form of taxes, and then they spend money. But we spend more than we take in. And so as a result, we have to borrow. And so when someone buys a bond, they're loaning money to the US government. And we consider that to be risk-free, because ultimately the government can print money. So the idea is, this is sort of the risk-free rate. It's it's cheaper for the US government to borrow money than it would be for you or me to borrow money. So what you see is, like, here are this side of this chart we call the short end of the yield curve. It's just like when the government's borrowing for shorter time frames. And here at this side, we start to talk about this as like the longer end of the yield curve. And so that interest rate is just the rate that the US government pays to borrow money from us. And what you'll find is your parents and grandparents probably own some treasury bonds. They've loaned money to the government. Mutual funds, hedge funds, endowments that are that fund a lot of the universities that you're going to go to, all invest in treasury bonds. And so it's just part of their portfolio. And so this is the yield curve. We're going to talk more about this in current events in just a moment. But then the question is, like, let's think about the short end of the yield curve. Like, we'll talk about the 2-year yield. What is that? It's not some mystical number. Like, one of the things that I spend a lot of time teaching my students at the University of Texas is that, I don't want you to think that it's some mystical number, that it just appears. Markets are determining every day, moment by moment, what interest rates should be for all these different time frames. And what I'm showing you here on this chart is the intuition you should have about short-term interest rates. One of the questions I asked you in the polling was, what does the Fed do when there's inflation? When there's high inflation, the Fed raises the Fed funds rate. What the Fed funds rate is, what you can think of it as, it's really the shortest term interest rate. It's really an overnight rate. And that overnight rate helps us to think about longer term rates. And so what the market does is the market thinks of the 2-year rate, which is in red, as what the Fed funds rate is now and what it's going to average over the next 2 years. And so what you see, like, let's just take a look in your 2017 and 18, and you see the red line above the blue line, because it was saying, the market was saying, we think the Fed is going to keep raising the Fed funds rate. And the market was right. And the Fed funds rate kept going up. And then in late 2018, in the fourth quarter, the economy started to slow. And the market started saying, wow, the Fed's not going to be able to keep raising rates. In fact, they're going to have to lower rates. And you saw the 2-year yield come down, reflecting, yes, the Fed funds rate is higher right now, but it's going to come down. And they were right. And then, of course, we got to the pandemic and they took rates to zero, because they take rates low when they're trying to stimulate growth. When you make money cheap, when it's cheap for me to borrow money, then I'll buy a house or I'll buy a car or whatever people borrow money to buy. And what you see right now is that the 2-year yield is above the Fed funds rate, because the Fed is currently raising rates. And the Fed, what's called the FOMC, the Federal Open Market Committee, meets twice a quarter, about every 6 weeks, and they decide what to do with the Fed funds rate. Now, they can meet more frequently than this. They can have emergency meetings, but their scheduled meetings are twice a quarter. So the market is telling you that they expect the Fed to keep raising, raising the Fed funds rate. When you look at longer term rates, you can think of them in the same way. You can think of them as the Fed funds rate and what we think it's going to average over the next 10 years, and maybe what we call a little bit of a term premium, a little bit extra compensation, because I'm taking a risk by tying my money up for 10 years. But what we tend to see overall is that the 10-year interest rate, the 10-year yield, tends to be correlated with economic growth, nominal growth, meaning every day we get economic indicators. And when they tell us the economy is growing at a faster rate than expected, interest rates go up. The 10-year yield goes up. And when we hear inflation's higher than expected, interest rates go up. When we find out that we're growing slower than expected, interest rates go down. When we find out that inflation is lower than expected, interest rates go down. So that's the kind of thing that we see. That's how interest rates are set. That's a lot, but I would tell you, if you think about that and understand that, you know more than, honestly, 99% of the population. They just sort of hear what interest rates are, and they think that, oh, it's some mystical number that somehow is set by the government. It's not. The Federal Reserve sets the Fed funds rate. Everything else is set by the markets. The markets, investors are buying and selling and to determine these rates. One other thing to realize is that you have, when you think about the U.S. Treasury, as I said, that's risk-free. But not all, companies are not risk-free. Companies have risk. And what I have here is what's called a spread. the spread on riskier companies. We have bonds that we call investment grade bonds. Those are companies like IBM that are, pretty stable, that sort of thing. And then you have riskier bonds, what we call junk bonds. And junk bonds, since they're riskier, investors demand a higher return to invest in them. And so what this is showing you is the extra return investors need above the risk-free rate. And so look at what you see. When times are really bad, the shaded area was the recession with the pandemic. When people are really scared, they need a lot more return to invest. In other words, in addition to the risk-free rate, they needed another 10.5 or 11% to justify loaning money to a risky company. Why? Because in recession, when the economy is slowing, that's when those companies can default. Their business is slowing down. They lose revenue. In other words, customers stop buying from them. Then they can't make their interest payments. Questions about that? Any questions before I move on to sort of the current events? You can just speak up if you have a question, but otherwise I'll move on to the current events. All right. So let's think about what's going on right now in the markets. What's everyone watching? So I've broken this up into the economy, interest rates, and stocks. And then I also have a slide just to sort of encourage you to keep up. So, and how to keep up. So one of the things you might have heard about is that inflation has been really high. Inflation just means prices are going up. And so there are two main inflation indicators. Yesterday morning, we got the CPI, the Consumer Price Index, and that's the most widely followed inflation indicator. The Fed actually doesn't use that. They use a slightly different indicator, what's called the Personal Consumption Expenditure, or PCE price index. And they're a little different how they're comprised. And you can see that they typically move together. On average, the CPI is higher than the PCE. The CPI looks at this basket of goods and services that we buy. But that basket is really fixed, meaning they look at the basket and they say, well, people normally buy this much beef and this much chicken, and how did the price of that change? The PCE actually looks at what we did buy during a period, and that's harder to put together. But what happens is when the price of beef goes up, people substitute and they start buying chicken, right? And they move to cheaper goods, and so because of that substitution, what you see is the PCE is typically a little lower. We also look at other measures. These are what's called a headline number. A lot of people look at what's called the core inflation, where we strip out food and energy because those are really volatile. But regardless, the thing that you should see from this chart is, back when I was your age, I was born in 1964. And so, back when I was, you go to 1980, like when I was 16, look at how high inflation was. It was crazy. It was crazy. So I don't want to hear any of you whining about inflation. It was much worse when I was your age. But this is bad inflation. And so, the Fed wants to get rid of that. And so that's why the Fed is raising rates. One of the things that a lot of people have been talking about is the fact that, well, with these higher prices, people have a lot of excess savings, more savings than we would have expected them to have. And it's because of the pandemic. And a lot of people think that that's because the government sent people money. And the government did send a lot of people money. And that certainly had an impact. But the majority of excess savings don't come from that. In fact, most of the people in the higher income levels didn't get money from the government. The reason that people have excess savings is because we just didn't spend as much. I'm married, I've got 3 kids, and we normally go on like a summer trip every year. Well, in 2020, we didn't go on a summer trip. And you think about that, to, if we go away for, let's say, 10 days and, we've got 5 airline tickets and hotel rooms for, for all of us, and whatever we're doing, wherever we get to, you're probably looking at what, $10,000. Well, that was $10,000 we didn't spend. And then 2020, we didn't do it either. And so that's how people have all this extra money, is they didn't spend, and it doesn't have to be a big trip. They just didn't go out to eat, right? For a long time, you probably didn't go out to eat. The only, there were a few months where it seemed like all we did was, one of us went to the grocery store. In my family, we had this vote, right? Because we were really scared of COVID. Everyone was scared of COVID, and we didn't really know much about it early on. And, we had a vote of who should go, because my wife always went to the grocery store. But we had this vote of like, who's the least valuable member of the family, right, that we can send to the grocery. I lost 5-0. Anyway, so I did the grocery shopping during those few months. But that's what happens. That's why people have excess savings. They just didn't spend money. And so there's this thought that, well, people are going to be able to keep spending because they have this excess savings. I'm not sure that that's quite true. In aggregate, we have a lot of money, but it really just belongs to the people who are in higher income levels. And so, yes, they should be able to keep spending even with higher prices, but others maybe not so much. Why do we hate inflation so much? So one of what you have, a lot of you probably heard about the Fed chair. The Fed chairman is Jerome Powell, also known as Jay Powell. But we have all these different Federal Reserve banks. We have 12 different banks across the country. We're here in Austin, we're part of the Dallas district. But each one has a president. Each of those 12 districts has a president, and they often speak. And it's a great way to follow the economy and know what's going on, because you want to know what the Fed is thinking about, because they have so much impact. And so the Fed president from Richmond spoke last week, and he was talking about, why is it that we hate inflation so much? And he says, one reason is it just creates all this uncertainty. We don't know when to spend, when to save, where to invest. We don't know how much prices are going to change. Should I buy something now? Should I wait? Is it going to come down? I mean, think about cars. A lot of you guys are at the age when you're buying a car for the first time, or getting a car for the first time, and cars have become incredibly expensive. Used cars are incredibly expensive. It makes us uncertain. Should we wait? My son, I have a son who's 20 years old, and he has a car, and we were talking about maybe we should sell his car because he doesn't take it to college with him. Maybe we should sell it, hold on to that money, invest that money, and then in a couple of years when he gets out of college, hopefully car prices will be a little lower and he could get a nicer car. These are the things we think about. Inflation's exhausting. That you may come from a family, some of you probably come from families where upper middle income or upper income, and you don't really think about inflation that much. But for a lot of people, it really impacts their budget. And so they have to shop around and find better prices. When you work at a business, all your customers are complaining about higher prices. One of the things I always tell my students is become observant, right? Become observant. Get your head out of your phone and become observant. Watch what's going on in the world. Meaning, a good thing to do, one of the things I do a lot is when you see gas prices go up. Right now they've gone up. They've been coming down for the last month or so, or 2 months now. But one of the things to do is walk around when you're getting gas at the gas station and look at the pumps where people are done. And it costs whatever, $50 or more, when gas is $4 or $5 per gallon to fill up. And you'll see a lot of the pumps stopped at $25 or $30. That didn't fill someone's tank. They had a budget constraint, right? And so it tells you that this is impacting people, right? Because it doesn't make any sense to just put half a tank of gas in your car. You're going to use it and you're going to have to go back. But it does make sense if you don't have the money to fill it up. And so you notice things like that. And then inflation seems unfair. One of the things we know from doing studies is that everyone thinks whatever they buy has gone up the most, and so it's like my wife and I, we spend a lot of our money right now on college. My two boys are at private schools, and it's super expensive. But everyone feels like, oh, whatever I buy has gone up the most. Everyone thinks their personal inflation rate is higher. And so, those are some of the reasons why we hate inflation. Question becomes how high will the Fed take the Fed funds rate, or the federal funds rate? A lot of people call it, and I call it the Fed funds rate. It's officially the federal funds rate. But this is something, I just pulled this last night off, that you can, all you have to do is say Fed funds rate quote, or Fed funds futures quotes. And so this is a particular type of contract that people are betting on what the Fed funds rate is going to be. And all you have to know is approximately, there's a more precise way of doing this, but approximately what you have to do is just take this last price and subtract it from 100. And that tells you what people are thinking is going to happen to the Fed funds rate. So what you can see is, like, let's just look at March of 2023. At that point, investors think 100 minus 96.4, right? That's 3.60. So they think that the Fed funds rate is going to be a little bit higher than 3.5%. And so that's roughly how high right now markets think that the Fed funds rate is going to go. And, we'll see. It had been higher than that, the expectation, but it came down when inflation came down a little bit yesterday morning. When it got reported, people said, oh, maybe the Fed won't have to raise rates quite as much. We'll see what happens with all this. People ask, are we having a recession? One of the things that I learned growing up is that what practitioners tend to say is, when you have 2 consecutive quarters of GDP growth, of GDP shrinkage, of negative growth, that's a recession. And that's how practitioners define a recession. But officially, let me see if I forgot to put the slide in that I wanted, but officially, recession is defined by economists at something called the NBER, the National Bureau of Economic Research. And it's, for a lot of us who study this and think about this, there's no question we've had 2 quarters of negative GDP growth. Part of it is just that we've exported a little bit less because it's hard to sell to other countries that are having problems. Look at all the problems Europe's having, with Russia invading Ukraine, and Russia limiting the amount of gas that's being sent to Europe. Europe has seen a tremendous increase in their price of energy. Well, if I'm spending all my money on energy, then I don't have money to buy goods from the US, that kind of thing. So we've seen some things like that. We've seen some things with companies not investing as much in their inventory. But it's just hard for us to believe that this is a recession when the job market is so strong. And so, what you see is, a week ago, the first Friday of every month, we find out about our labor market. We get the most important report about jobs, the employment report, and we added 528,000 jobs, even though we were only expecting about 258,000. So the jobs market is much stronger. People have jobs, and we've replaced all of the jobs. We lost like 22 million jobs in the pandemic. We've replaced all of them. So we have a really strong labor market. And what you see is the unemployment rate is down to 3.5%. And look over time, in the last 50 years, we've really never been that low. And so that tells you, it's like hard to say we're in a recession when we have such a strong job market. One thing, though, that we're all worried about is the fact that what's called the participation rate is lower. You're participating in the labor force if you have a job or you're actively looking for a job. If if you're not looking for a job, you're not participating, you count as unemployed, that kind of thing. You have to be looking for a job to count as unemployed. And so what you see is we've had a drop in the participation rate. Now, the participation rate has been coming down over time, partly because baby boomers, the people born from 1946 to 1964, have been retiring. I'm the very last year of the baby boomers. So when you make fun of boomers, you're making fun of me, but I'm good with that. My kids are always saying to me, okay, boomer. I'm good with that though. What you see is a smaller percentage of people 16 and older are in the labor force right now. Some people dropped out just because of COVID, fear of COVID. Some people have long COVID, right? And they can't go back to work. Others have had to take care of kids. Most schools have gone back, but there's a lot less daycare available now. And so people have to stay home with their kids, or it's too expensive. It's not worth work if you're spending all your money with daycare. You've also had people retire. It's not that retirement. There was a lot of stories saying, oh, more people retiring. That's not necessarily true. What happened is actually when people retire, some percentage of them come back for two reasons. One reason is they are bored. Another reason is they don't have enough money, they realize. So what's happening is there are fewer people coming back. One reason people are coming back is because of COVID, or because a lot of work is online, and that doesn't solve boredom. That's still boring working online, right? So, but one thing we do think is going to start to bring more retirees back into the labor force is inflation. People are going to realize, wow, I don't have enough money, and they're gonna come back. Let's see what else we have. Oh, the next thing I'm talking about is interest rates. What I've done here, remember how I showed you the yield curve? Typically what happens with the yield curve is it's upward sloping. Short-term rates are low, longer-term rates are high. What I've done here is I've taken the 10-year interest rate, the 10-year yield, and subtracted the 2-year yield. Normally the 10-year is higher than the 2-year. When they're the same, it's at 0, that means. And right now the 2-year is higher. Take a look at this chart. Whenever it's gone below 0, which means an inverted yield curve, meaning short-term rates are higher than longer-term rates. Shortly thereafter, we had one of these shaded areas, which is recession. So yield curve inverted, we have recession. Yield curve inverted, recession. Inverted, recession. Inverted, recession. We had the pandemic, and now we're inverted again. Everyone's scared about that. Why does it invert? The short end goes up because the Fed's trying to slow the economy to get rid of inflation. And then the long end, the expectation of future growth goes down. And so that's what people are talking about right now in the real world. Show you a few other things about stocks. So here, what you see is this year, interest rates have gone up. They've come down recently, but since the start of the year, interest rates, as the 10-year yield, has gone up. Well, look at what happened to multiples this year. Multiples have come down, meaning how much people are willing to pay for $1 of earnings of companies has come down. And then recently they've gone up a little bit as interest rates have come down. That inverse relationship I told you about earlier. Interestingly, though, margins are still pretty high, or very high. Margins are, for every $1 of sales, how much earnings do I have? You would have thought, like, oh, with this inflation, isn't it going to come down? And the answer is no. Think about it. We've had 8.5% inflation over the last year. But what's my biggest expense as a company? It's workers. Workers' wages have only gone up 5 or 6%. So what you see is workers aren't keeping up with inflation. They're losing out. You get a 5% raise, but prices are going up 8 or 9%. You lost. You were worse off. And that's what we're seeing. But the companies are better off on average, not every company. But if I can raise prices 9% and only pay my workers 5% more, I won. And so that's part of what we're seeing. One of the other things everyone's talking about is estimates for future earnings are coming down because we're fearful that the economy is slow and people are going to be able to buy less with higher inflation. This is just showing you what I started by talking about, was what's going to happens with our returns. And you can see returns are a combination of 3 things. the change in multiple, your earnings growth, and then the dividend. And the dividend is sort of in red or pink, and it's always very small. But like if you look at the first quarter of this year, interest rates went up, so multiples went down, and that drove stock prices down. Recently, multiples have gone up as interest rates have gone down. And so that's what we've seen. A lot of people are talking about, are we in a bull market? Meaning a bull market means, the market is rising and going to hit new highs. Or are we in what's called a bear market? Bear market's when the market is 20% lower than its high, but a bear market rally, just meaning that, yeah, the market's been going up recently, but it's going to eventually go back down. We won't know until after the fact, but that's what people are talking about right now. Finally, just because young people are interested in Bitcoin, I just want to show you Bitcoin tends to be highly correlated with NASDAQ technology stocks, meaning people speculate on Bitcoin. It's, we don't know its true value, but people speculate, and they, when they're buying risky stocks, they're buying Bitcoin and vice versa. I'll end just by encouraging you to keep up. These are some of the things that I read on a daily basis. But what I would tell you is, that's my job, is I follow the markets. I teach about the markets. I speak about them all the time. It's not your job, right? But you want to learn about it. And I would pick one of these, like whatever you like. And I would subscribe. They have student subscription rates, or most of them do. Barron's, I think, is the single best thing. It comes out once a week. I mean, it also has online that they put out stories throughout the week, but it comes out once a week. You can read it online. And the reason I'm a huge fan of Barron's is that the Wall Street Journal and Financial Times, which, I love both of them, they tell me about the news. Barron's tells me about how the market has reacted to the news. And I think that that's what students want to learn. Those are the connections you want to make. That's sort of what I teach all about. The Daily Shot is a really interesting service. They send, every morning I get about 100 charts about the US stock market, the economy, foreign stocks, foreign markets. It's really an amazing service. Anyway, that's some of the stuff I do and think about. I know that's a lot, especially for those of you who are new to this, but I hope what it does is just makes you think, I want to know this. It's not that you have to know this now, it's that you want to know this. One of the best things you can do if you want to learn about stuff like this is pick one of these things and outline an article each day. Just one. If you do that every day, and you do that for 365 articles, a year from now, you'll know so much more. And even though some of the things in the articles won't make sense to you, when you keep hearing it, eventually it will. And that's a lot of what I did, and that's a lot of how I learned. And to me, watching the markets and the economy, it's like watching sports, and it's like, I can't believe I get paid to do it. And so it's just an awesome thing, and it will take care of your financial future. So I hope this, maybe it didn't all make sense to you, but hopefully it encourages you to start following it. Tina, I don't know, we might have a minute or two for questions. I'm happy to do that. Or
I think we have 2 minutes. I'll just see if any question pops up. We do have one. What's a piece of business news in the last year that impressed you the most?
Let me see what what's a piece of business in the last year that impressed me the most? I as far as impressing me the most, I think that, I guess I tend to, I don't know about impressing me. I think, impacting the markets, I tend to be a big Fed follower. So I think that impressed me the most. I think, one of the things that makes me feel good is to see, as far as just impressing me the most, is I've started to see maybe a change in how people view Elon Musk. I think, my students for years, they just love Elon Musk. I think there's no question he's brilliant, and the kinds of things he's done, just absolutely amazing. But I also think that, some of the other things he's done, sort of tearing down Twitter, making a bid, and then trying to get out of it, I think is pretty poor. So I think that's probably been something I've been happy to see, that people have been locked into their views, as polarized as we are, and have sort of switched their opinions there. Again, think he's a genius, but I think that's sort of probably what's made me think there, just that people have changed their views.
I have a question for you actually.
Sure.
So would you say a good way to practice what people have learned is paper trading? Because I've heard a lot of people like paper trading, just trying to practice what they learn. Do you think that's a good way to practice?
Paper trading is a great way to practice. It's not perfect, but it's a great way. Making decisions and realizing that stocks don't go straight up and that no one is right all the time is a great way. The other thing I would say is, right when you start making money, start investing, because the one thing you can't get from paper trading is the emotion. And we study something called behavioral finance, and it's we don't act rationally. I remember when I started investing, and when I would see my account go down, I mean, it was so painful. It's like, I worked so hard for this money and now I'm losing it just like that. I worked all day and I'm worse off. That's painful. You have to have this long-term perspective, and you have to learn how to deal with those emotions. And so paper trading is awesome. It's also, I would almost say, awesome to tell people what you're doing on that paper trading, because even just that reputational risk gives you a cost. And what you have to realize is, you're going to lose money at times, and especially early on. And one of the worst things that'll ever happen to you is if you make money early on, because you're going to think you're a genius. And we all have good times and bad times in the markets. And so, but I think it's a great way to get started. But then once you start making money, use real money. Well, the funny thing is, like, I look back and how stressed I was when I was losing money when I started investing. And now you look at it when you get older, and it was like rounding error. It was meaningless amount of money, but it seemed really important back then. But as you get older, you obviously accumulate more. And then you look back and you're like, I can't believe I worried about that. But I did. And that's the only reason I was able to invest as I got older. So that's what I would say. How truly accurate are stock market predictions? And the answer is not very good at all. What you should do is watch CNBC and write down what everyone says. Some people are going to be right, some people are going to be wrong, and the people who are right are going to be wrong the next time. Like, it is a hard game to play. You're competing against the smartest minds in the world, or some of them, because there's so much money at stake. Everyone wants that money. And so to think that you can just beat them, that's a hard thing to do. Should I not listen to anyone who claims that they can predict oil prices? Oil prices is an interesting market, and the answer is that, again, no one's going to be perfect at predicting oil prices. You can see the huge swings that we've had in the last 2 years, and even just in since March and since the invasion, we've had huge swings, and people saying we're going to 200, and then we're back down to 90, and then people, we start back down to 90, and people are saying, oh, we're going to get to 70. People tend to tell you what's happened yesterday, but people are studying the supply and the demand, and things change. The supply issues have changed. We thought we were going to lose a lot more Russian oil than we have. A lot of it's made its way to the market. Demand, we think, is starting to weaken now because of weaker GDP. When the world economy is growing at a slower rate, we consume less oil. But there are other things also driving it up, and so these are things we do with everything. There's no way to tell you exactly what's going to happen. Who makes money is the people who make the best predictions, but you also have to be able to understand you're not going to be right every time, and that's what we do. And we shouldn't expect anyone to be right. If we always remember where someone got it wrong, then we don't listen to anyone. You want to be able to listen to everyone's views, take it in, and form your own view as to what is your best opinion.
All right. I think that's all the time we have for right now, but we want to thank you, Mr. Leeds, for coming and speaking to us, because this was just an amazing speech.
You're very welcome. Let me say one other thing. I meant to put on here and I didn't. And Harrison, you mentioned this earlier, sandyleeds.com, SANDYLEEDS.com. It's all free. It's the notes we use in my class about current events. If you go there, you can sign up for an email that comes out every Sunday afternoon at 4 Central Time. You will get an email after you sign up that you have to open up, and then you have to click on the link. Otherwise, it will never get to you. And if you use Gmail, that email probably has gone to the trash or junk file. And so you have to go pull it out, bring it into your inbox, click on it, then you'll actually get it. But if you don't get the email on Sunday afternoon, if you sign up, that's what it is. I don't look at who signs up. It doesn't faze me at all. I don't care. But if you're interested, that's a good way to keep up too.
I'll send the link in the chat. So everyone could just click on it. But thank you so much, Mr. Leeds. I know you're a busy man. Your time is precious. Just really appreciate you coming this morning to speak to us.
Great. Well, good for you for putting this all together. And thank you so much for including me. I hope you guys all enjoy the rest of your conference.
Thank you so much.
Thank you.
Stay in touch.
You too. Thanks.